Today's presentation is focused on a Q&A. So I have a few questions that I'm going to ask our guest speakers, kind of like in an interview style, and then that'll be a set of questions to build off of and get us going. So people know the topic that we're going to be on today. Let me share this. We've called the presentation Preserving Your 401k, but it's also about long-term investors protecting the principal of their investment in or out of a 401k. And we wanted to have this conversation about fixed income and fixed income instruments because it's been a very unique period of time, and we want to make sure that participants in the 401k and our clients understand a bit about the unprecedented times we're in, but also how it's similar to a lot of other things we've seen in the past, and differentiate between kind of the urban myths of investing in fixed income versus what's actually going on right now in the markets, in the bond market. We have a couple guest presenters. We have Ramil Betpolis who will be joining us here in a moment from Guggenheim, and we have Brady Morrison, Senior Associate at PIMCO. Brady, can you wave, at least say hello?
Hey everyone, great to be here.
For those that have already joined us and should know that you've seen them in your investments or in your 401k options, I can tell you personally, I've had relationships with both companies over 15 years. And so I've invited them today because I think they're large institutions in fixed income that have shown a good track record and practice in how they go about buying and valuing bonds. And so what I'd like to do is invite anybody to ask a question as we go into the Q&A and use the chat feature. Does anybody need any assistance with that before we get started with the questions on how to use the chat feature? Just raise your hand or let us know. Okay, I didn't see it. All right. So I'm gonna pose the first question to Brady to get us going. Why have bonds performed poorly this first half of the year? What would you provide as an explanation for that, Brady?
Yeah, that's a fantastic question, and it's top of mind for a lot of investors this year as they look at their statements. So thanks for having me on. Really excited to be here. So if you think about kind of the backdrop for this year, as I'm sure everyone here is acutely aware, inflation is a problem. It's as high as it's been for decades. I'm in the market for a new car. It's pretty exorbitant what you have to pay for a new car. I see it when I go to barbecue. Inflation is pretty much up across the board. And so when we think about the Federal Reserve, their responsibility is essentially twofold, right? They want to maximize employment. They also want price stability, i.e. kind of low and stable inflation. So we think about the primary tool in their toolkit for handling inflation, it's generally interest rates. And we think about the effects of interest rates on bonds, it's usually a headwind for bond performance. And so coming into the year, the Federal Reserve and a lot of other investors out there projected that inflation would be transitory. Essentially, it would come and go. And so most investors expected maybe 3 to 4 rate hikes out of the Federal Reserve in 2022. You know, when all is said and done, it looks like we're actually going to get about 14 rate hikes out of the Fed. And so you've had pretty much an unprecedented amount of rate hikes and interest rate spikes in such a condensed time. It's been a pretty strong headwind to fixed income performance. And so when we think about, you know, bond prices going down because interest rates are going higher as the Fed tries to fight inflation, it generally hurts fixed income performance. And I'm sure we've all seen that. I think the benefit here is that even though it has kind of headwinds in the near term, generally you see short-term pain translate into long-term gain. And so if you think about the most correlated factor to future fixed income returns, it's actually starting yields. And if you look at kind of the 2-year treasury as kind of a barometer, it's as high as it's been since pre-2008. So even though we've seen some kind of pain here to start the year, and I don't want to downplay that at all, starting yields are in a really interesting spot where investors can get some interesting return within their fixed income allocation to the portfolio. So I think really we've had an unprecedented start the year in fixed income because we've had a lot of rate hikes kind of baked into a short period of time.
Jacques, can you hear me?
Yes, I can. I'm going to go ahead, Ramil, and ask you to give your response and then remind everyone that's just joined a little late that Ramil is answering this question: why have bonds poorly provided principal preservation in 2022? And Ramil comes to us from Guggenheim Investments. Go ahead, Ramil.
Thank you so much for having me join the call. Brady's comments are spot on. Just to kind of echo what he's stating, I think as bond investors, when folks invest in bonds, they're looking for safe haven or yield instruments to provide them with ballast within their portfolios. And as Brady mentioned, the Federal Reserve does have a dual mandate to keep full employment and keep inflation in check. It's a Herculean task. Some of the main factors that have created those headwinds, as Brady mentioned, first and foremost, last year, if you take a look at what took place, there was a lot of residual effects from the pandemic, and you simply saw a lot of supply-demand imbalances that are still residual from last year. Secondly, as Brady mentioned, you would see the tail end last year in December, the Federal Reserve stated that inflation was transitory and they didn't need to take any action on rates. Now, that's the second component of that table that has caused this downturn. The third component is immediately thereafter, the very first week of January, the Federal Reserve stated that they're going to have to make some moves in interest rates to quell the inflation picture and really slow down the economy. Then you have that exacerbated furthermore by not only by the war in Ukraine and Russia, but also by COVID. So all those culmination of events caused a lot of headwind in fixed income, a lot of uncertainty with the Federal Reserve, causing bonds to have really the worst period they've had in almost 40 years. So this has really been a time that's hasn't been precedented in many of our lifetimes, but that's where we're at today. And as Brady mentioned, now everything across the yield curve has been repriced. So hence you're getting very attractive yields that date back to pre-pandemic levels and even pre-mortgage debacle periods. So right now, the yields that are being able to render out of fixed income have been the highest they have been in a long time. And that's really what's caused the imbalance in fixed income. And historically, there's an inverse relationship between stocks and bonds, but as we as investors know, that has not been the case here more recently.
All right, Ramil, I want to stop you there. Thanks for that response. And for those attendees, we haven't had a lot of questions come in yet. So just pose to everyone in the chat a question that you may have, and we'll go through the ones that are general, and those that are individualized, we're going to encourage you to meet with us. Now, I want to pick up on something here from Ramil. You talked about bonds are a ballast. Now, if you've been on a sailboat, that analogy makes a lot of sense. But if you haven't spent a lot of time thinking about bonds, I want to talk a little bit about what that word means from an investment perspective. Ballast in this sense is bonds in an environment of stock market being down are intended to preserve and protect principal. But what we've seen is that there's been a strong positive relationship when stocks have gone down with bonds going down. And we call that mathematically a correlation. Now, if you look here over a period of 22 years, this chart shows you the relationship between the Bloomberg Aggregate Index for bonds versus the stock market. And what I'd like you to note is more than a majority of the time, bonds have a negative relationship. So when stocks are going down, we would expect that a majority of the time they go up. But this year, you notice there's this blip on the far right of the chart. that it goes up in a positive way. And so I'd like, going back to Brady, to one, ask you why is that happening this year, this positive blip, this positive relationship, and when might it change? And this is kind of what Ramil was alluding at the end of his comments, that it may be changing in the second half.
Yeah. So I think it's a common theme here when you think about that correlation between stocks and bonds being positive this year. It's kind of a familiar culprit being inflation. So if you think about the drivers of this correlation, there's a bunch of different factors you could potentially point to. But if you think about inflation, it's pretty bad for fixed income because it means rates are going higher, like we spoke about. And then also, if you think about stocks, it's also negative for stocks. If you think about inflation, all these companies needing to buy and source their goods to then sell to customers and pay employees more, these costs are going up for businesses as well. And so it kind of, it hurts stocks in terms of their margins and the revenues they're able to generate and kind of bottom line performance in terms of companies. And so that's, I think, the main driver of why you've seen that correlation become positive between the two asset classes this year. I think the benefit is, to our previous comments, yields are a lot higher in fixed income, and we do see a lot of the rate hikes out of the Fed being priced into the market. So I think we're at a place where we could start to see that negative correlation and that ballast, as Jacques mentioned, on a go-forward basis. So if you think about the purpose of fixed income, if we go back to Q1 of 2020, you saw everyone's portfolios, their S&P 500 equity index was down 20%. You saw bonds post a positive performance. I think we're at a point where yields have risen. And, if we think about rising rates hurting fixed income, the opposite is also true. So dropping interest rates helps fixed income. And if we do get into a recessionary environment where the Fed decides to, instead of increasing rates, whether it's 1, 2, 3 years down the road, and the flip happens where they decide to decrease rates, I think that's where you'd start to see that real negative correlation kick in and kind of help investors' portfolios.
Ramil, do you have anything to add to that?
I think that's pretty much spot on. Other component to keep in mind is now some of the folks on the call may not be too familiar with what spreads are, but basically spreads are anything above the 10-year treasury. And what we also saw beginning this year, spreads started widening. So going back to what Brady was mentioning, he's spot on. Historically, they have provided a safe haven. And really, the Fed is trying to maneuver a soft landing. And as you may all know, the statement goes true that a bull market never dies on its own merits. It's really the Fed taking it out back and shooting in the head due to the fact that they're trying to quell inflation. And hence, they're going to continue stifling this economy by raising rates to the point where it really squeezes the monetary supply to companies. And I think the areas that are most impacted by rising rates in the stock market are really in technology companies, because they use so much of those assets to borrow, buy back their own stocks, and also whether it's in the form of mergers and acquisitions or expansions, they really heavily rely on low interest rates to borrow. And that's going to really slow down with where rates are headed to. And ultimately, what will take place is the Fed, if they do not engineer a soft landing, they do not tread the needle per se, they will begin cutting rates again, and at which time, as Brady mentioned, that will again have a positive impact to fixed income investors. And additionally, I think it's pertinent to mention there are asset classes in fixed income that do adjust based off of where interest rates are. So as interest rates go up, some asset classes do behave positively in that type of environment. But again, those are very, very few asset classes within fixed income, because fixed income is an enormous landscape, right? The Barclays Act, which we all benchmark to, is a $25 trillion marketplace, whereas the entire fixed income universe is a $50 trillion marketplace. So you can imagine there's portions of that entire spectrum where you can pinpoint areas that can have a positive effect. But again, that's not to say that that's all you can invest in.
I want to interject here a question that we've had. And the question is, how successful do you predict the Fed will be with the soft landing? It seems like historically has not worked well. And if any of you have spoken to me, the analogy that Larry Sumner's put in a Barron's article, I think Ramil you and I talked about this article recently. It talks about if the Fed's policy was adjusting the heat in the boiler room, how well can they have lukewarm water come out, up many floors in the hotel? And the reality is they don't have a good history to it. To Lori's question, they don't have a good track record with it, because my take on it from investing, over 20 years is that if their objective is to control inflation and have price stability, and they want to get to 2%, and we're currently in the high 8s, they're going to slow the economy with raising rates, and they may have a recession. Now, if you've also talked to me, you've heard me say, well, we're not in a recession now. So when it does transpire that they slow, how far away it is. And so back to Larry Sumner's analogy, traditionally it's about 18 months, time between adjusting in the boiler room to you see an outcome of recession or not, and the water coming out scalding hot in a recession, or something better like a lukewarm. So that it's a very difficult with this instrument of controlling rates, whether or not they will be successful. What does PIMCO have to say about this?
Yeah, I think we agree in terms of it's really challenging for the Fed to engineer a soft landing, and there's very few instances that they've done so in the past. So in our house view here at PIMCO is that we will find ourselves in a recession in the next, let's call it 12 to 24 months, because the Fed, even though it has a dual mandate, it's purely focused on fighting inflation, and Federal Reserve Chairman Powell hasn't explicitly stated they're going to do so at the risk of rising unemployment. But if you kind of read between the lines, our view is that they're going to hike rates, they're going to get inflation under control, kind of regardless of what it takes. They're pretty much on a war path to get inflation under control. I think another interesting question is what does that recession look like? In our view, some have compared it to a hurricane potentially coming. We would compare it to steady rain, in the sense that we think it'll be a little more shallow than maybe what we saw in 08 as one example, but it might be a little longer in duration, because if inflation is still kind of out there and lingering, we don't know that the Fed will necessarily rush in to cut rates, or that Washington will provide huge fiscal stimulus packages like we saw in 2020 to save the economy, because they're going to be a little scared that inflation is going to get out of the bag again. So we think it'll be less shallow, because there's really strong employment at the moment, which will help kind of buffer the economic downturn. But it could be longer lasting, because you're probably going to see less intervention from the Fed and kind of Washington, D.C.
And I would concur with Brady. I think he nailed it dead on. To tread that needle is extremely difficult. If you take a look, empirically speaking, the Federal Reserve has been around since 1913. Of all the mandates that they've had and all the times that they've tried to orchestrate and engineer a soft landing, they've only been able to do 10% of the time. So we need to put that in perspective. Historically, 90% of the time, the Federal Reserve has failed in orchestrating a soft landing. Hence, we don't believe that's going to be much different this time around. And I think, as Brady mentioned, the focal point for the Fed is combating inflation at all costs, even if it renders us, going into a recession. They are prepared to have the economy go into recession in order to really sustain the economy and really limit inflation, and having inflation run out of control. That is their number one priority. And we believe there ultimately is going to be a recession. Now, to say whether we're already in one or not, I think the caveat to that right now, which is different than many other scenarios that played out, is the fact that we have a very low unemployment rate. And that's contrary to historical norms of seeing that within the economy. Historically, we see unemployment rates really high in times of really a recession. So as Jacques mentioned, it takes anywhere 12 to 18 months for the rate hikes to actually filter their way into the economy. And I think the jury's still out, but it's going to take a little time for this to occur. And once the recession occurs, in our opinion, it's going to be short-lived because you have so many different components come into play again. The household debt was very attractive coming into this because everybody was, stuck at home due to the pandemic. So household savings were very nice. I think spending was very low, and that will help cushion a lot of that. And then furthermore, as you take a look at corporate balance sheets, they're still very favorable. Balance sheets are favorable for companies. Their interest to debt ratios are attractive. So we see this not being a long-lived environment for a recession, but more of one that would be, a very short and moderate recession versus what we've seen in other past cycles.
So I wanted to make a comment here, and I think going back to the question of how successful will the Fed be, I think there's a lot of consensus that they won't do a good job, but I think the more important thing is to think personally about how much time do you have on your hands, and what I mean by that is the whole thing of investing is taking advantage of compound interest over the long term. So if you need money for a home renovation or you need a cash reserve to deal with unexpected expenses, or you've recently had a newborn child and you're now dealing with a new cash flow stream, the good news in this situation is cash now pays something. It didn't pay anything for a very long time. But if you're about to retire and head off to Spain, or you've been working for a long time at the university, maybe this is the time, regardless of our prognosis, just to be more conservative, because those early years of retirement are fragile to the next 30 years. And so your reaction should be a little different. And so this is where maybe you schedule some time to have a more in-depth one-on-one conversation. I want to segue to a different question that we had posed by Gabriella. In effect, I've lost some money in my portfolio thus far year to date. And will the election make a difference, to paraphrase? Any comments, Brady, on that?
Yeah, in terms of kind of upcoming midterm elections. So our view here at PIMCO is that there's going to be continued gridlock. It appears it's fluctuating on pretty much on a day-to-day basis in terms of who's going to win each chamber of Congress. Our view is that conservatives will take either one or both chambers of Congress. And what's that going to mean? Essentially, that's going to mean that there's going to be continued gridlock. And so you're unlikely to see continued fiscal stimulus out of Washington because one, the inflationary concerns. And so we think the most recent quote unquote Inflation Reduction Act is likely the last kind of large stimulus that we'll see out of Washington, D.C. And then I think the second reason for that is simply because although there has been quite a few bipartisan deals that have come through this year, kind of impressively, with both sides kind of agreeing to some extent, we think that's not going to be the case going forward with kind of gridlock in Washington. So I think in terms of kind of a fiscal tailwind, we don't think that's going to be the case kind of going forward. Assuming midterms kind of keep kind of the two chambers of Congress split, if that makes sense.
Ramil, any thoughts?
I think we completely concur on what Brady just mentioned. We're in the same camp.
Yeah, I would say that I agree. The thing that I've gone back to over the last few years is based on the extreme politics that it equates to gridlock, it equates to kicking the can down the road. So if there's two games in town, monetary policy by the Fed and fiscal policy by the legislature, I don't expect much of anything from the legislature to move the dial. So this is why the markets are following so deeply what's happening in, the Black Hole Symposium this week, is because there's not a lot that's really going to change policy from an election. So I'm going to see if we have any other questions. And then I'm going to go, I don't see anything yet. Andy, please update me there. And then I'm going to ask this question to Brady. I'm going to share my screen. Talk a little bit about, in this environment where we've had rates dropping for 45 years and now the trend is shifting, going upward, how is PIMCO trying to find value these days? Where are you finding value in the bond market?
Yeah, that's a fantastic question. So I think in terms of how we find value, PIMCO, we like to say that we're a liquidity provider during times of volatility. So what that means is when we do see these kind of negative performance periods, there's a lot of investors that like to kind of run for the hills and sell their assets. And if we can buy them at a steep discount, we have a pretty large firm that could take advantage of those discounted prices. And so that's one of the ways in which we use our size in order to source a lot of interesting securities and positions for our investors. And if we think about where specifically we're finding value in the market, when we think about different positions within the fixed income market, we've talked about rates rising pretty dramatically here, right? And so if we're looking at the short-term, high-quality fixed income space, we're seeing a lot of value there in terms of bang for your buck. There's a lot of different scenarios that we could find. We could find ourselves in a recession like we've talked about. We could potentially, a small chance, but maybe we'll be in a soft landing. We think playing in that kind of short-term fixed income space adds a lot of value for investors because it balances, having high quality and also interesting yields of, a lot of times north of 4%. So if we think about where we're finding value, it's in discounted assets that other people are kind of selling into the market, we're able to take advantage of, but also where we find value specifically is kind of in that short-term, high quality fixed income space.
Ramil, how's Guggenheim going about finding value?
Well, our mantra really is we are a multi-sector relative value firm. As I mentioned previously in our discussions, the fixed income marketplace is a $50 trillion marketplace. We are scouring the entire fixed income universe to find out where the value is, where is a dislocation within fixed income, where has been oversold or overbought. Hence, we have a dashboard we call a credit dashboard, and what we evaluate is historically what percentile are those assets trading at, and a lot of those asset classes are trading at a discount because everything has been, the baby has really been thrown out with the bathwater. So to state it simply, we are seeing opportunities across the fixed income spectrum. We are seeing really good opportunities. We are still keen on credit. So, if you take a look, we do have an allocation to asset classes such as bank loans, which adjust every 30, 60, 90 days as rates go up. High yield has been historically a good area to be in as the Fed starts their liftoff, because again, the economy is thriving, hence the Fed is attempting to slow down the economy. We also like asset classes such as asset-backed securities. Those are everything in the form of shipping containers, railroad cars, cell phone towers, billboards. They all have a revenue stream associated with them. They're investment grade, and also they adjust as interest rates go up. And if we go back to 2008's torturous market, we saw little to no defaults in A and AA credit quality in that asset class. And lastly, the area that we like and are very keen on right now is really investment grade corporates. Meaning, if you take a look back at the trough of the market, we were very defensive going the pandemic. We were sitting a lot of cash. because we expected some exogenous event to occur because, again, corporate America was over levered. So once the pandemic took place, we were sitting on a lot of cash, and we deployed a lot of cash in the area which was the most beaten down. And that was investment grade corporates, which we hold now. And as spreads have been widening, we have been adding to credit and to investment grade corporates due to the fact that we see historically these asset classes are trading at a discount. So, whether you are utilizing, PIMCO's, outrageously impressive lineup of funds or Guggenheim's, we are truly just mainly fixed income investors, and we try to identify and isolate where the best opportunities are based on risk adjusted returns. And truly, we see fixed income right now as a very, prime time to take advantage of this dislocation and allocate really some resources to those areas.
Thank you for that, Ramil. And I also want to again thank Brady. We're at about a half hour, so we're going to end the conversation here. We encourage you to, one second, Lorraine.
Okay.
We encourage you to sign up for a one-on-one meeting if you want to talk about something personal. And then I'm going to give Lorraine here the table. Lorraine?
Yeah, I can't force a send on the chat. I do have a question. Can I read it? I can't make it send for some reason.
Yeah, go ahead, Lorraine. Yeah,
If you're already retired, should one consider living within Social Security for daily expenses if possible versus using retirement dollars at this time and pay off large expenses with some of the retirement dollars? And of course, Jacques, that's going to be in our meeting we're having later this month.
Yeah. I think this question,
since you got two experts, I thought I'd ask.
I'm gonna take the answer here fairly quickly, and then I'll let them add to it if they like. The shorter answer is, if you're in California,
yep,
it's a miracle if you can live just off your Social Security. So if you're able to do that, I commend you. But folks, the majority of us have witnessed a great transition. In the real estate numbers that came out this week, we're talking about the supply of real estate has been limited, but there's vastly different activity in real estate between the South, places like Austin, Texas, Tennessee, and what's going on in California. And we're having a e-migration. We're having people leave California and go to other less expensive places because most people, Lorraine, can't do what you suggest, just live off of Social Security. So if you're trying to do what you suggest, it's obviously a one-on-one conversation we need to have.
Yeah, it's included in our one-on-one.
In the conversation there, thank you for the endorsement, Ramil. Brady, thank you for being here. And our friend Joe Django had a loss in the family, so blessings to everybody, and the best to him. Thanks for joining us, everybody, and hope to talk to you guys soon.